Hi, and welcome to our panel today. Joining me are some wonderful panelists, Rick, Wes, Peter, and David. I'm your host, Daniel Barankin, the founder and CEO of Six, and we're going to be focusing today looking at the banking crisis and its implication for gold and gold equities. To kick things off, I'm going to invite each panelist to begin with an introduction about themselves and about their companies. Rick, I'll kick it over to you to begin.
My name is Rick Van Nieuwenhuizen. I'm the president and CEO of Contango ORE. We're developing a high-grade 8 gram per ton ore deposit here in Alaska. We're doing it a little uniquely. We're not building a mill and a tailings facility like you'd normally have to do. We're going to use the existing facilities at the Fort Knox mine. We've partnered with Kinross in a 70-30 joint venture, them 70, us 30. We're through feasibility. We're under construction. I've just arranged $70 million of debt financing with ING and Macquarie. So we're kind of off to the races here. We're 90% completed or committed in terms of contracts in place. So I think we're relatively bulletproof to the wave of inflation that'll continue to hit us. Anyways, I'll look forward to the panel. Thank you.
Incredible. David, over to you.
Thank you. I'm David D'Onofrio. I'm the CEO of White Gold Corp. I'm also principal at the Power One Capital Group based in Toronto. Power One's a diversified merchant bank. However, we've had a very strong focus on commodities for, since our inception about 20 years ago now. The White Gold story was formed out of a partnership through ourselves and Sean Ryan. Sean Ryan's a notorious prospector who saw the Klondike district of the Yukon, saw that there was 20 million ounces of gold panned from the streams, and thought that, there's a good chance that there could be more gold below. And he went there and through a series of some pretty intricate research, was able to more or less crack the code, made a couple of very significant multi-million ounce discoveries in quite short order in mining exploration terms. These were both acquired by major mining companies. And through that process, he's basically tied up the entire district. We've gone and consolidated and now are the owner of one of those deposits. So we're quite a unique junior gold exploration company where we have some very advanced assets. We have gold ounces in the ground, approximately 1.8 million ounces in all categories, really good grade at 2+ grams, starting from surface. At the same time, we have a very exciting grassroots portfolio, which gives some real blue sky potential to the company. And our business model is to be a project generator. We have this, really prospective ground. We've seen what's led to these discoveries. We believe, there's many more discoveries to be had. This, in our view, is, one of Canada's, earlier but more exciting emerging gold camps with the history, and sort of fostering that view is the recent significant investment made by several major mining companies. We personally been able to track the investment of Agnico and Kinross as our strategic partners. Newmont is our neighbor. They own the coffee deposit, which Sean Ryan originally discovered with Kaminak. They are advancing that and permitting to production. We're also a neighbor with Western Copper and Gold, who has Rio, and they just recently announced a partnership with Mitsubishi. B2Gold has made a significant investment recently into the Yukon. Hecla has also done the same. So it's an exciting time where I think there's not many places in such great jurisdictions with this type of prospectivity and having seen such little work that exists. And we're really in a fortunate position to basically own the entire district. So it's a true district scale play, and we're looking to continue to make discoveries, look to vend those out to different partners that can advance them, and pay our shareholders and continue to sort of unlock the riches of this district of the Yukon.
Wonderful. Thank you, David. And Wes, over to you.
Hi, I'm Wes Hansen, President and CEO of Thunder Gold. Thunder Gold's primary asset is the Tower Mountain Gold Project, located 50 kilometers west of Thunder Bay, Ontario. We're looking for a large tonnage, low-grade gold deposit there, and we plan on leveraging our outstanding infrastructure that's already in place and use that to drive low-cost exploration and discover the next multi-million ounce gold deposit in Ontario.
Wonderful. And Peter, we're already seeing some love from the audience. Terry says, Peter Schiff fan here from Alabama. Troy says, we love Peter Schiff in Sacramento. I suspect that a lot of that love probably comes to do with some of the work you've done previously predicting the 2008 banking crisis. And more recently, a lot of the contributions you've been making on Twitter and others, but what we're seeing today. But for those that may not have a full familiarity with you, perhaps you could begin by giving us an overview of your background.
Well, sure. I'm currently the chief global strategist and economist for Europe Pacific Asset Management, and we're a SEC registered investment advisory firm. I'm based currently out of Puerto Rico, and we manage individual portfolios, separately managed accounts, as well as a family of mutual funds, one of which is the Europe Pacific Gold Fund, which is managed by Adrian Day, who worked for me at Europe Pacific Asset Management. And he also manages through Europe Pacific Asset Management separately managed accounts that are focused on the mining sector. So a lot of precious metals miners, but on a broader scale, we invest in a wide variety of assets that I believe will do well during a period of inflation. One in particular where the U.S. dollar is weakening and the U.S. economy is in recession or on the border of it, and you're seeing stronger growth taking place in emerging markets and in commodity-focused type businesses that we emphasize. But just quickly, you talk about my pick predicting the 2008 crisis. You called it a banking crisis, but we really called it a financial crisis. And when you introduced today's topic, you talked about the banking crisis, and that's what a lot of people are saying. They're calling it a banking crisis because they don't want to compare it to the 2008 financial crisis. But this is another financial crisis. There's no mistaking that. It's the same thing as 2008, except worse. So because this time the central banks inflated a much bigger bubble than the one that was inflated prior to 2008. So we should refer to it as a financial crisis because that's what it is.
And so with regards to this financial crisis that we're seeing unfold before our own eyes, there's various aspects to it. We're seeing double-digit inflation out of the United Kingdom and out of Europe more broadly. We're seeing inflation out of Canada, the United States. We've seen the second largest bank failure out of the United States with SVB. And all of this is happening in recent weeks. Peter, how did we get here?
Yeah. Well, first of all, don't make the mistake of thinking that this is all about COVID. I mean, certainly the foolish combination of monetary and fiscal policy during COVID added to the problem. We created a lot more inflation during the pandemic lockdowns because we stopped producing goods, but we continue to produce money. In fact, we increased the production of money as we decreased the production of goods. So that really, threw gasoline on the inflation fire. But the fire was already there prior to the pandemic, and now it's just bigger. But the inflation is the consequence of 10, 12 years of central banks deliberately creating inflation under the guise of quantitative easing. They collectively claimed that we didn't have enough inflation, that we were somehow below this 2% target that they concocted. And because the official government measures of consumer prices were not quite 2%, the central banks thought it was an emergency and they needed to save us from the perils of a cost of living that was not rising by 2% a year by creating a lot of inflation. Well, now those inflationary policies have caught up and we're experiencing the consequences. And now the governments are trying to belatedly put out the fires they lit, but they can't do it because paradoxically, the rate increases actually contribute to a rising consumer price index because interest rates are a cost, just like raw materials or labor. And when the cost goes up, businesses pass it on. So everybody is paying higher prices because central banks are raising interest rates. So it's like a dog trying to chase its tail. No matter how fast it runs, it's not going to catch it. And so as the Fed hikes rates to fight inflation, they make the inflation problem worse. Now, that doesn't mean they shouldn't hike rates. But the reason we have the inflation is not because the central banks lowered interest rates. It's because they had to print a lot of money to lower interest rates. They had to create inflation to buy government securities and mortgages to reduce the yields. It was the money printing that resulted in the inflation. But paradoxically, in the short run, that money printing did not cause consumer prices to go up because it brought interest rates down, which kind of suppressed consumer prices. But now rates are rising, and so this is a problem. And it's a particular problem for governments that have a lot of debt, like the United States, because when the Fed kept interest rates low, that kept the budget deficits much lower than they would have been, because the interest expense for the government on 30 trillion of debt was held artificially low. But now that rates are back to 5% and money that was borrowed at 25 basis points has to be rolled over at 500 basis points, when you got a 20-fold increase in your interest expense, budget deficits are going to soar. And that is highly inflationary, because at the end of the day, the Federal Reserve is going to monetize those deficits by returning to quantitative easing, which in fact it has already returned to bail out the banks. But it's not just the banks that are going to need to be bailed out. It's going to be the U.S. government, corporations, individuals. Everybody took on too much debt while interest rates were at zero or negative in Europe. And now those chickens have come home to roost now that interest rates are finally rising. And so all the air is coming out of the bubble. And again, this is much worse than 2008. I mean, 2008 was a Sunday school picnic compared to the massacre that we're going to see in the markets, as a result of the monetary mistakes this time.
In March 2020, we saw a pretty radical re-rating of gold equities, where I think on the 20th or 18th of March, we saw pretty much every gold equity collapse. And then shortly thereafter, over a period of months, we saw many of these companies get re-rated without any material announcements, to a tune of about 100% by the period. Rick, David, Wes, what are your expectations around what's going to happen as inflation and as generally the market looks at the assets that are ultimately you're developing? What are your expectations thereabouts?
Well, I'll jump in first. And I think Peter's absolutely right when you look at the money printing resulting in inflation, and you see it in the gold price. I mean, in that period, 2000 and post 2008 with the quantitative easing, before that we had a stable gold price in the $600 neighborhood, and then after we started printing the money, it went up to $1,200. It spiked at 2000, but it came back down and kind of mellowed out at 2000. Well, that's a double in a 3 year time frame. I think you saw the same thing, post COVID. Gold kind of stabilized, jumped back up to 2000, but then kind of is stabilized in the $1,800 range. And now we don't know. Now the Fed's between a rock and a hard spot. As Peter said, they can't really afford to increase rates too much. We've got effectively we have the same stagflation we had in the 70s, except we have a hell of a lot more debt now than we had in the 70s. So I think the Fed's, we do have a financial crisis, and it's not just limited to a few banks. So for us, we're going to go through an inflationary period. It's going to be here for a while, and it's I think doesn't have a lot of bullets left to fire here. For us, the good news is that we're 90% completed and committed on our contracted on our capital costs for our project. So we're not going to see a huge amount of continued inflation affect our project. And I think we're going to benefit from a continuing increase in gold price. We'll be producing 67,000 ounces of gold a year, with Kinross doing all the heavy lifting. So that's a scenario I kind of like for our shareholders. It makes us more like a royalty company. And I think we're going to see another doubling of the gold price before this is all said and done here in the next 5 years.
Yeah, I totally agree with what Rick there and Peter had said, and to your question of what does that mean for the gold equities? Obviously, no one has a crystal ball, but I think a large part of it depends on where you are, sort of in the stack of gold equities, whether you're a producer, a major, developer, or an explorer. And I also think it's going to be impacted by what's driving the gold price, right? So if we have a financial shock to the system. You know, when the SVB news came out, gold sort of jumped up. That was a crisis reaction flight to safety. Now, in the equity side of things, you know, if you're on the junior end of the spectrum, although your value should be tied to the commodity because of the earlier nature of the company, you know, that I think the market views those types of companies more as a risk equity. So I think they're going to trade more in line with risk equities, and I think that we've seen a lot of that in the last year. You know, as the rates have gone up, the risk trade has been off. You know, the tech companies have been crushed, but so have the junior gold companies, right? And I think that's because they're getting caught in that bucket. Now, if you can sort of look a little bit further down the road, there's, I think, currently the largest disconnect ever between the value of the underlying commodity and the value of some of, you know, probably the basket of these junior companies and companies with, you know, advanced deposits or whatever. You know, I think those are going to be, you know, positioned very well for a big re-rating when there's a little bit more stability to the system. And, you know, when and if gold prices continue to appreciate, but for other reasons, such as, you know, maybe interest rates pausing or coming down, weakening of the US dollar, which will also drive it. And then, you know, from there, I think there's a really unique opportunity now to sort of be taking positions in some of these like totally undervalued companies in anticipation of, you know, what could come next. So I think that's pretty, you know, a unique opportunity that, you know, faces the market right now. Maybe it's difficult, you know, when does that happen, today, tomorrow? You know, it's difficult to make those kind of risky bets now, yes. But I think what's also going to drive a lot of it is, you know, the profitability of the producers is going to, I think, improve significantly over time, right? They have their investments at sunk costs largely already. Their commodity prices are going to increase. A lot of their input prices are going to go down. You know, we've seen the price of oil come from 120 down to, you know, $70, whatever it is today. So to the extent those are looking better, I think that's going to bring in more people to the industry. I think, you know, from what I understand, the generalist community is not there at all yet, right? Maybe we start to get some more attention from that. And then eventually, you know, there's that trickle down effect where it goes from the majors to the mid tiers to the juniors. And what could also be happening, and, you know, we can look forward to, is if that disconnect continues, we're going to see more M&A. So I think we've started to see some M&A already. And, you know, just sort of my, you know, involvement in the market in other capacities, I'm starting to see more of that, you know, ramping up and a lot of tires being kicked just because, you know, these assets are just so deeply discounted that the majors, you know, would be sort of foolish not to sort of take them over when they can.
Mm-hmm. Everybody's made some great points, of course, but the number one rule of investing is buy low and sell high. And it's really, I've never seen the industry in such a state of, you know, bargains in terms of investment opportunities across the board in the gold mining space. So, I mean, this is a great time for people to get their bets in and invest in, you know, a combination of juniors and smaller producers and developers and majors, and establish a position in the gold space, because gold price is only going one way. It's only gone one way in the last 25 years. It's virtually impossible to find a 5-year period where the gold price hasn't appreciated. So get your bets in and buy junior companies and other gold producers that have solid fundamentals, like good management teams and good properties and good opportunities for success, and ride that wave, because, you know, the supply demand side on the gold space is fundamentally solid. I don't see that changing. You know, we kind of look through the lens of North American investors, but, you know, in terms of the gold price in Canada and other countries in the world, it's never been higher. In terms of buying, in terms of physical gold, both in terms of bar and coin and in jewelry, the third world is driving that investment, and I don't see that's. I don't think that's going to change in the near future.
One of the emergent themes out of this conversation that I'm hearing is this idea of the flight to safety. And what's really interesting is that the flight to safety is fundamentally what collapses banks. It's what collapses SVB, as people are withdrawing their deposits and fleeing the bank to find safety elsewhere because they don't want that counterparty risk. What I find really unique about the Silicon Valley Bank story is that, by way of looking at why it collapsed, a large part is where it invested. And what it invested were the safety assets that governments were instructing it to invest. SVB purchased treasuries. SVB purchased mortgage-backed securities. SVB did, by all intents and purposes, everything that was being directed to it over the preceding years by the federal government and basically by these various regulations in terms of what's permissible to invest in. Peter, you've been an outspoken critic of central bank digital currencies for a very long time. These central bank digital currencies are increasingly coming to light, either by the Bank of Japan and by various federal reserves and agencies and governments around the world, as kind of an alternative to this current financial situation, with the idea that investors and consumers can find safety in those assets when they're ultimately released. Why are you an outspoken critic, and what risks do you see with government-issued central bank digital currencies?
Well, I mean, first of all, there's not going to be any safety in a government-issued cryptocurrency. I mean, it's just going to be a cryptocurrency backed by its own currency, right? In the case of the United States, it'd be the Federal Reserve note, otherwise known as U.S. dollars. So there's no safety there. I mean, if all you care about is preserving your dollars, then you might say your dollars are safe. But if you care about preserving the purchasing power, there's no safety at all. The purchasing power is going to evaporate over time. I mean, we've already decided that inflation is the poison that we're going to pick. The government is not going to allow defaults, bankruptcies, financial crisis. Everybody gets bailed out with inflation. That's what's already happening right now with these banks. And, just because Silicon Valley Bank bought treasuries didn't mean they weren't taking risks. They were taking tremendous risks. They were buying long-term treasuries with interest rates at record lows. They were buying the top of a bubble. But the regulators didn't care. As long as they claimed they were going to hold these bonds to maturity, then they were able to put them on their books without a haircut and never have to mark them to market. But, Silicon Valley Bank needed the money because the customers wanted money. They had to sell. But more and more bank customers are going to want their money because the banks can't raise interest rates enough to compete with treasuries because they've already locked up the money in long-term low-yielding debt. And they're never going to be able to offer a yield that even comes close to matching the inflation rate. And so as the public comes to terms with the new reality of very high, maybe double-digit inflation annually, as far as the eye can see, nobody is going to leave any money in a bank. You're going to take it out. You're going to have to do something else with it. I mean, maybe you'll buy gold or silver with it. There used to be an opportunity cost. If you bought gold and silver, you gave up the interest that you could earn in the bank. Well, you can't earn any interest in the bank. Even though the Fed has jacked up interest rates, go look at your bank. There's no interest there. You've got to buy a CD, or you got to lock the money up, or you got to buy a money market, but that sucks the money out of that banking system, and it puts a lot of pressure on the banks. And the reason that gold has stayed relatively low, even though it's near record highs in dollars and it's at record highs in just about every other currency, but the public still doesn't appreciate how much inflation we're going to have. They still believe the Fed can bring us right back to the good old days of 2% inflation. Those days are gone forever. They're never coming back. And it would take me longer than this program to really explain why that is the case, but it's not going to happen. And so when investors realize that inflation is going to be very high, then they have to reprice gold for a higher inflationary market. And so the value of gold is much higher if you assume inflation is 10% a year versus if you assume that it's 2% a year. And of course, that's all going to lead to a dramatic revaluation of the mining sector. I mean, ironically, mining stocks have been one of the biggest victims of inflation because inflation has driven up the cost of mining. But because investors expect it to go away, they don't expect it to continue, gold hasn't gone up nearly as fast as the cost of getting it out of the ground. So that has put a lot of pressure on these mining companies. But I think what's going to happen is that gold is going to have to catch up as it's re-rated for a higher inflation environment. And all of a sudden, the price of gold is going to rise much faster than the cost to mine it. And that's when the profits of the gold mining sector is going to surge. A lot of the producers will be able to increase their dividends substantially. And all these securities will be a lot more attractive. And you're going to see a rush to get in I think right now the only people that invest in gold stocks are in the fringes, just like me. I don't think it's very mainstream. I don't think if you looked at pension funds, endowments, the hedge funds, any of the major players around the world, they have very little to no exposure in mining stocks. And when they realize that they need to have some exposure, and they will eventually realize this, because as some of their competitors begin to incorporate mining stocks into their portfolio, and then they start outperforming as a result of that allocation, that puts pressure on everybody else to do it. And so you have a lot of money trying to get into a very small, window, and prices could go up very, very fast. I mean, so yeah, you got to buy these securities now. You can try to pick the stocks yourself, or you can entrust somebody like Adrian Day, who manages our strategies and our mutual fund, to do it for you. He's been doing it for, I think, 30, 40 years. I think he's the best at it. And so I hired him to manage my portfolio. Even I don't know enough about, geology and the mines to know, which are the best ones to buy. So I hire somebody smarter than me to do it. I mean, I'm smart enough to know that gold's going way up, and smart enough to know that the gold mining stocks are going to make a lot of money. I just don't know which ones will make the most and which ones might not make anything. That's especially true if you're in the juniors, where they're not actually in production and they're doing exploration. So, it's more difficult to know which ones to buy there and which ones to avoid. And that's where, a guy like Adrian really adds value and earns his pay.
Absolutely. And like you, Peter, I've been following the gold sector, and I'm a huge fan of this market, as fringe as it may be. And I've been doing so for about a decade. And what's interesting is that the experience I've had since I entered to today is that gold stocks are competing against the S&P 500, which can return 15% year over year on a relatively risk-free liquid basis. It's competing against cannabis stocks. It's competing against cryptocurrencies. What's notable is that at this particular moment in time, we're seeing the phenomenon around what a low interest rate environment yields fundamentally change with inflation. We're seeing a war against cryptocurrencies on the regulatory side in terms of subpoenas, as well as documents being served to folks ranging from YouTube influencers like Logan Paul all the way through to CEOs of companies like Binance with Suzy and others. And so we're seeing this fundamental shift where the alternatives for how to generate yield are fundamentally moving and shifting away. Wes, I know you've been in the game for a number of years. Last time we spoke, I think you mentioned more than a couple of decades. What are your expectations around how this changing macroeconomic environment, what that means for your company, what that means for the mining industry, and more broadly, what that means for the economy as a whole?
Wow, that's a broad scope, but in terms of a junior company such as Thunder Gold, it's we're not immediately impacted by short-term changes in gold prices, and our viewpoint is years, not days or weeks or months. It's we're playing the long game here with our exploration opportunities, and that's what juniors should be doing. They should be out there looking to double resources every year over the next 5-year period, so that they're adding value for the shareholders going forward. And that's kind of our focus with Thunder Gold, as we see an opportunity on a large tonnage, low grade asset such as Tower Mountain to double our resource and reserve our resources. Sorry, I shouldn't say the word reserves at this stage, but hopefully we'll get there someday. And that's that becomes attractive for the majors to look at acquiring a company such as Thunder Gold in the future if we're successful in that path, and taking us out, making us go away. And that's really what juniors should be focused on, is providing the mines of the future. So we look at these large tonnage, low grade opportunities as future, and that's got to be our focus in developing that, so that we're taking advantage of the gold price 5 years down the road. That's I can't prognosticate what that dollar value is going to be in terms of gold price 5 years from now, but I know it's going to be significantly higher than what it is today. So, that's a fairly decent return on your investment. I mean, gold has been the second highest performer in terms of return on investment over the last 25-year period, after stocks like global stocks and equities, right? So it's performed very well in the past. I think it's going to perform very well in the future, and I think it's a tremendous opportunity given the fact that juniors and intermediate producers and senior producers in the gold space over the last 10 years have just been hammered down. Like they're significantly undervalued, and this is the time that investors have to make money.
Maybe just picking up on what Wes was just talking about, and I think Peter alluded to this as well. I mean, one of the big challenges right now is inflation. A dollar doesn't go as far as it used to go, and it certainly hits exploration. It doesn't just hit the mining operation. I mean, you can see it very easily there with operating costs increasing, but it also affects how much work you can get done. And one of the other things that are facing the industry is the lack of people. I mean, we see this across the country in all sorts of jobs, whether it's at going to the restaurant or certainly anything in the service sector. But we also see it in the exploration sector. There are very few people to choose to go do your work, and of those, fewer and fewer of them actually want to go out into the field. Well, you don't find ore deposits sitting behind your computer screen having a Zoom meeting. You got to go bang rocks, and we're at a real challenging part for the exploration business, and especially when you start thinking about all the copper we need and all the host of metals we need to meet the new electric future, all electric future. We just don't have the people to do it, and we don't have the interest in the young people to do it. So there's some huge challenges that are more than just inflation related. I mean, they actually increase the odds of having more inflation, and we certainly see that in our sector. So I think this is another aspect of why I believe the companies that can manage through this process and find more resources and find more reserves, and because that's what it really counts. That's what you got to get to, is getting a reserve that you can either develop yourself or have a big company come in and partner or buy you out. But it's certainly not an easy process, and it takes dollars, and those dollars don't go as far anymore.
Yeah, that's a great point. Like from the supply side, I think just to extend that line of thinking a little bit further, if you look at the last decade, there's been a relative, significant underinvestment in junior exploration. Right, the markets went through a big lull, sort of in 2011, kind of right until 2019, where these exploration companies just couldn't access the kind of capital they needed to, and then that's the pipeline of supply, right? So it takes a long time to build mines, for better or worse, right? You got to make the discovery, you got to get it permitted. You're looking at a decade, and so stuff that's being put into production now has been discovered 10 years ago, but nothing's happened in the last 10 years on a relative basis. So once those reserves are depleted, where are they going to get this? And that's going to drive this inflationary pressure on these prices. But flip side of that, people do have gold or had success or finding whatever the commodity is. They should be the benefactor of the higher prices.
On the topic of inflation, Tim Wright asks, if quantitative easing is a euphemism for inflation, then logically quantitative tightening would reduce inflation. If interest rate hikes increase prices, why not burn currency with quantitative tightening and leave interest rates low, kind of bringing things back to that 2% inflationary environment that we've seen over the past decade? So why can't that, as Tim asks, be a solution?
Is that a question for me?
Go for it, Peter. All yours.
Yeah, well, first of all, now that inflation is demonstrably higher than 2%, the low interest rates won't work. The interest rate, hikes won't even work. But people are not going to save money if inflation is destroying its value. So if they think they're being adequately compensated for their savings, then they'll do it. But if you believe inflation is going to be 10%, you're not going to put your money away at 2% or 3%. You're not going to buy government bonds. You're not going to loan it out. You're either going to spend it now before prices go up, or you're going to use it to acquire real assets that will maintain their value. So the government the central banks cannot do that again. They can't just lower interest rates and get away with it. And the rate hikes, yes, they're contributing to the rising costs of living, but they need to be even greater hikes. That's the problem, because the hikes, even though they've hiked rates, they're not high enough to compensate for the loss of purchasing power due to inflation. But the broader problem is that no central bank can fight inflation by itself. It needs the cooperation of the governments. The governments have to cut spending, and actually they need to generate surpluses to repay debt, but that's not going to happen. Now, if the central banks were really willing to force governments into insolvency, if central banks were willing to force governments to cut back on their entitlement spending, then yes, they could fight inflation. But no central banks are willing to do that. I mean, for all the talk about how independent they are, they're not independent at all. They do the bidding of government. And so the government is not going to allow the central bank to force them to cut Social Security or Medicare or even defense. And they're certainly not going to default on the debt, which is preferable to having it inflated away. But from a political perspective, politicians always choose inflation over default. And that's where we are. I mean, the central banks got away with this magic trick for a while, but it's trick's over. The illusion's worn off. I mean, they're done. And so now it's dealing with the consequences and figuring out who to blame. And of course, the government, the central banks are going to try to blame the private sector. They're going to try to blame capitalism. Look at these hearings today about the failure of Silicon Valley Bank. They're blaming it on deregulation. They're claiming the problem was we didn't have enough regulation. No matter how much regulation the government puts on an industry, they blame every failure on that there wasn't enough of it. When the reality is it's government regulations that cause the problem, because they circumvent the free market regulation that actually works. So these politicians think that you need government to regulate a market. You don't. You need competition. You need capitalism to regulate markets. That does a much better job. Whenever government tries to replace the free market, it never works. It ends in disaster, which is why we keep seeing this.
Yeah, I mean the head of SVB was on the San Francisco Fed, so I mean, is he apparently self-regulation doesn't work too well? So,
well, no, self-regulation doesn't work. Market regulation works. Competition. People, you don't put your money in a bank that's not sound, unless the government guarantees it. We need banks competing with one another based on which bank has the soundest portfolio, which bank is the least likely to fail. That's where the market would encourage deposits in the healthiest, soundest banks that were the least likely to fail. But once government insures the deposits, nobody gives a damn about the soundness of a bank. They put their money in any bank, whichever one is closest. And so the free market safeguards are completely dismantled by the moral hazard of government.
And so on the idea of moral hazards and how individuals can safeguard and protect themselves, we have a question from Thierry asking about goldbacks. Firstly, are you familiar with them? And if you are, what do you think about them as a way to buy highly fractionalized gold for the low-income buyer?
Am I familiar with what?
Goldbacks.
I don't know what that is. Gold-backed what?
Oh,
you mean cryptos?
Thierry, any additional clarification? Cool. So we'll move on from that question, and as more information comes in, I'll pass it along. The other question that we have from the audience is from John, also to Peter Schiff, asking around any interesting aspects of ESG affecting your strategy and your decision making. In particular, do you perform ESG due diligence on your investments?
No, I mean, I'm not in charge of the portfolio management. I don't pick the stocks. But no, we're not, basing our stock selection in any of our strategies on ESG. We're investors. We're not activists, and we're trying to generate good returns. And so we're investing in companies that are focused on the bottom line, on generating returns, and minimizing risk to the shareholders. I'm not investing in some company because of their virtue signaling about the environment or any of these other causes that they want to prioritize over their real business, which is to, if it's a mine, it's to, generate profits for the shareholders through the mining of precious metals, the acquisition of reserves, and growing the value of the business. That's what I care about. The rest of it's going to take care of itself. And if people are interested in supporting all sorts of causes, then they could take the dividends that they earn on their investments or profits from selling, and they can contribute to charities or do what they want. But these corporations are not charitable enterprises. That's not why they've been formed. That's not why they're there. I think part of the problem with companies like Silicon Valley Bank is they spent too much time paying attention to all this nonsense and not worrying about the risks inherent on their balance sheet from all these long duration, low yielding bonds that they were foolish enough to load up on.
Any additional analysis or commentary, David, Rick, or Wes, on the ESG theme?
Look, I'd just say
I
that
think
mining companies in general have been doing ESG for a long time. Mining is a local enterprise, and you have to work with the communities. You have to have a dialogue and develop a project in concert with the local community. We've been doing that a long time. Do we always fill out the scorecard? Probably not. And is that a good thing to do? Maybe it is. But I would agree with Peter. I think there's been far too much attention on trying for companies, trying to look like they're doing the right things when they're not. I mean, Nike, runs all sorts of sweatshops all over the world, but they have a good scorecard, I'm sure.
Rick nails it exactly on the head. I think the mining industry as a whole has always been under more scrutiny than perhaps a lot of other sectors in terms of their environmental stewardship and responsibilities, and mining companies do a good job of that. They are, particularly companies in Canada and the US, have done an excellent job in terms of setting standards for environmental stewardship that other countries have to strive towards, and that's a good thing. Same with hiring practices, same with contributing to the local economy and working with local interest groups and being productive members of society. I mean, that's the entire process. So, as a junior explorer, we don't have that much opportunity to demonstrate that, but that's just part of the game. We're just trying to find ounces of gold in the ground, and that's what our focus is directed towards.
Definitely makes sense. As the global macroeconomic environment shifts, Mark asks, what implications will the recent Saudi and China oil refinery deal have on the US dollar, price of oil, and price of gold? And this is an open question for anyone that would like to jump into it.
What was the question?
The question is, what implications will the recent Saudi and China oil refinery deal have on the US dollar, price of oil, and price of gold?
Yeah, well,
I'll just jump in here. I mean, what's going on macro picture wise is East versus West. I mean, when you have China, after years of us attempting to get Saudi and Iran, to the table, and we failed miserably, China's able to do that. That's a fundamental shift in power, and the alliance between the odd alliance between Russia and China, who have never really gotten along. They share a long border. They both don't trust each other, but now they're buddies, and we have this proxy war going on in the Ukraine. I mean, there is a huge shift going on here. It's a de-dollarization shift. China, Russia, Saudis, India, Brazil, a whole bunch of countries that make up more than half of the world aren't crazy about continuing to just do business in dollars. That is a fundamental shift. It's not going to happen overnight. The dollar still represents 60% of all trading going on, but it's a shift that's in the process, and fundamental floor shift.
Yeah, although at some point it will happen overnight. How did you go bankrupt? Well, slowly at first, then all at once. And, so the dollar is going to have a day where it just collapses. There's going to be a dollar crisis. And what you're seeing, that deal that was announced, not just the brokered peace talks, which shows China's growing influence in the region, but that refinery that's being built in China by Saudi Aramco, and the deal that the Chinese are striking with that company for the purchase of oil. I think it's pretty safe to say that in 2 or 3 years, China is not going to be paying for that oil in U.S. dollars. They're not going to buy Saudi crude with U.S. dollars. They're going to be transacting in their own currency or in gold or something, but it's not going to be the U.S. dollar. And if you look at the countries that were just mentioned, these are some of the countries with which the United States runs the largest trade deficits. And that means those are the countries that we depend most on for our standard of living, because they supply us with goods that we need and we can't produce ourselves. And we're able to acquire those goods at no cost because we just print money. It costs us nothing, and we just use that. But when the world is able to de-dollarize, which they were going to do anyway, and we've simply accelerated the process by weaponizing the dollar and really showing them why they need to get rid of the dollar as quickly as they can to try to neutralize this weapon, it's going to happen fast. And when the dollar crashes, American trade deficits go away because we can't afford to import anymore, because we can only import if we can export. And we can't export because we don't produce, because we don't have the factories. We don't have the supply chains. We don't have the skilled labor. So, our whole standard of living is going to come collapsing down. And I do think that in that de-dollarized world, what is going to be the primary reserve asset? Is it going to be the euro? Is it going to be the yen? Is it going to be the RMB? I don't think so. I think there's only one qualified, monetary instrument that can supplant the dollar, and that's gold. That's it. Before the dollar, it was gold. And when it initially became the dollar, it was only because the dollar was backed by gold and redeemable in gold. So gold is the only monetary anchor that is going to work. It's the only real money that is not simultaneously someone else's liability. That's where we're headed. And that's going to be the irony for all these crypto guys, because they think gold is dead. No. It's about to get a whole new lease on life. And in fact, gold 2.0 would be a marriage between gold and the blockchain, where we can tokenize gold, and instead of having fiat paper currency backed by gold, we have digital currency backed by gold, and that'll work. And then all this Bitcoin and the crypto nonsense will be just another memory, maybe in the history book. So instead of tulip mania, we could talk about crypto mania.
Peter, there's another Peter named Peter Zeihan. He was a geopolitical strategist, and he talks quite broadly around his forecast and projections for what's going to happen as the world ultimately bifurcates in its economic systems. And he paints a rather optimistic view of North America. In particular, his argument is that uniquely North America as a continent is best situated to experience economic growth and development because of the resources that are local to the grounds and areas here, because of the knowledge and institutions that we have, our population, etc. David, Rick, Wes, each of you are at a various point of the exploration, development, production life cycle here in North America at least one project. What are your thoughts around the future of North America's prosperity?
I'm an optimist. I'm an exploration geologist, so I think I have to be. But for our project, we're a year away from producing gold. We're not building a mill. We're not building a tailings facility. We're fully permitted. We have a big company partner. We're using their mill that's been operating for 25 years, and their tailings facility that's been operating flawlessly for 25 years. So, I think for investment in Contango, you're looking at an investment in getting cash flow, and then what do we do with that cash flow? Do we dividend it? Do we grow the company? So, if we're generating 67,000 ounces of gold on average a year, and we've got $1,100 all-in sustaining costs. And at $1,900 gold, you're generating over $50 million of free cash flow. That's a pretty compelling story. So, I'm very happy to be an optimist in that scenario. And I think for all the reasons we've been talking about, we're going to see the gold price continue to perform well. And so I think we just need a little bit of political free will to happen here in the U.S. and elections coming up shortly. So, another year or so away. I'm hoping people actually start to think about how they vote and who they vote for. So those are my thoughts.
What's really interesting to me in the last year, maybe a little bit more, is the rhetoric that's coming out of the government in North America about the support for streamlining mining permitting. Right? It seems like they realize now, whether it's security of supply, which is a very topical issue in the critical mineral space, the battery supply chain, that with some of these other, China or whoever, being so dominant, that the local governments are saying, like, we need to de-risk ourselves and build up our own supply chain. And the only way to do that is you got to be able to let these projects advance quickly, and also help with on the financial side of things. So in the U.S. you see that with the Inflation Reduction Act. In Canada, they're sort of having similar concepts. We're starting to see a lot of the right verbiage coming out of the government. Obviously, it's early days, so let's see how this plays out. But I think that's setting the table for significant advancements to the industry. Right, like the problem, like I mentioned earlier, this stuff takes time. The permitting process is a big part of it. Obviously, a lot of that is for good cause. You want to make sure that these are sound. You want to make sure that the right environmental protocols are being followed, etc. But there's reasonability here. So if that can sort of continue to play out, I think that'll be very helpful. And the fact that we see governments investing financially in these projects is a huge shift, right? I know in the Yukon, where we are, the federal and territorial government have made direct dollar investments to specifically help support mining, exploration and development. So this is something that's new, and I think it's very important, and it'll be very helpful. And really looking forward to that as another value add for the sector that we can look forward to.
It's too bad Rick had to drop off, but he's absolutely there's really few things on earth less useful than a pessimistic exploration geologist. So I have to agree with that. But North America does have the goods. We've got everything we need here. And the problem, I think, North American, the North American dynamic is we lack the value add. What happens after we mine the metals? We have the metals in the ground, but it's converting them into the value add products downstream that's lacking. We're sending a lot of that offshore, and I think it has to come back to North America. We have to invest in smelters and produce our own steel and produce our own copper products and produce our we're great on the gold front, thank goodness, because everybody sees the value upside opportunity of gold. But it's the other strategic metals like copper and lithium and so on and so forth that we have to get those processing facilities built. The other thing that I find detracts from North American opportunities is just there's not a lot of people entering the mining space. It's not attractive to young people. It's very difficult to find exploration geologists and mining engineers and find the talent that you need to successfully discover and develop and operate mines, and regardless of the commodity. And that's the challenge that our society faces. And it's mind-boggling to me, because it's been an outstanding career for myself. And two of my children are actually involved in the mining business. One is a mining engineer and one is a geologist. So I've done my bit. I can't offer any more.
There's a skills shortage in a lot of things, not just geologists or things like that. I mean, Americans have wasted tremendous amounts of time in government schools learning absolutely nothing. And our young people stay in college until they're 25, 26. They graduate with nothing but debt, but they don't have any marketable skills. They really haven't learned anything. They certainly haven't learned any trades. But you know, in North America, sure, we have a lot of natural resources, and that's great. All else being equal, having resources is better than not having them. But the most important resource to have is economic freedom, because you have areas of the world that have pretty much no resources at all, and that are thriving and have very high standards of living. And then you have other parts of the world that are rich in natural resources, and their people are starving. And the difference is government and freedom. So if you have big government, doesn't matter how many resources you have, you know, you're not going to develop them. You're going to be impoverished. And even if you have no resources, human ingenuity, if allowed to function, you will figure out how to thrive. And so the biggest problem that we're going to have to overcome in North America is democracy. That's it. You know, and it's the average voter is a socialist, you know, doesn't understand the free market and thinks that government can give them whatever they want, that government has some magic horn of plenty and out of which you can get whatever you want. And so, you know, when we go through this next crisis, it could be a catalyst for a totalitarian society to emerge. I mean, we've been moving in that direction for years and years in the United States. We've moved away from freedom towards, you know, totalitarian or socialism, and we could advance in that direction much quicker if we have, or when we have, the acceleration of this current crisis, and when inflation really starts to rear its head, and the policy response is price controls, and then we have shortages and black markets and blackouts and riots and all sorts of things. That's a fertile environment for corrupt government to usurp even more power. So it's hard to necessarily be an optimist. I mean, you can hope for the best, but you know, I don't know that I would want to bet on it.
I think you're absolutely on the mark here, Peter. I think that the fundamental ethos of governments around the world is never waste a good crisis. And what they view as what it means not to waste a good crisis, usually it is the consolidation of power. We have a question here, it came in a bit earlier, talking about Executive Order 14067, which is the ensuring responsible development of digital assets. Earlier, Peter, you projected a vision of the world where really the only tangible way that we get out of, let's say, that we return to sound money, whether using gold directly, is the digitization of gold. And that's where we put the bit blockchain technology to use. As governments, corruptible as they may be, continue to go and act in the ways that consolidate power, how do you reconcile that optimistic view of gold-backed digital currencies with the more likely realities of restrictions on the amount of money you can spend, restrictions on when you can spend it, restrictions on every aspect of your economic life, to the point where you have declining economic freedom rather than increasing and improving economic freedom?
Yeah. I mean, there's no sense that, no question that governments are going to try to fight back if they perceive a loss of power and competition from gold. And digital currency certainly makes gold more efficient as a medium of exchange and far superior to US dollars. And so, you know, people will want it. Just like, you know, the taxi cabs had a hard time competing with Uber. You know, hotels are having a tough time with Airbnb, and the post office had a hard time with Federal Express. I mean, whenever you have a free market alternative to a government monopoly, you know, get improvements, and the customers prefer it. So yes, you know, I can see crackdowns on stable coins, you know, backed by gold. So they're stable to gold, not to fiat currencies, which are anything but stable. But it's a big world. And as the world de-dollarizes and moves away from the dollar, the ability of the US government to flex its muscle and punish other countries for allowing digital currencies backed by gold will be diminished. And even the United States tries to outlaw it here, they're not going to succeed in outlawing it throughout the world. And they're not going to be able to stop people from getting a hold of it. Look, governments can make anything they want illegal. You know, all kinds of drugs are illegal, yet people do them. I mean, you could take an example of a prison, right? I mean, government's got people locked up in prisons, yet they're doing drugs in prisons. You know, and you know, so you can't even stop it there when, you know, when they're behind, people are behind bars. So in a digital world with the internet and everything going on, even if the U.S. government outlawed something, if I access something from another country, how are they going to know? So I think that it's going to succeed, despite some governments' efforts to impede that success through regulation and taxation. But to the extent that the government is able to drive some people away from being able to transact with a tokenized gold, well, they'll transact with silver, or they'll do it in physical. They'll make exchanges, because when prices really start to rise, and then you start to develop black markets because of price controls, or local merchants are not going to want to get paid in a collapsing fiat currency. So if they don't have the alternative to accept a digital currency that's backed by gold, if they can't do that because of some kind of legal impediments to doing that, they can accept coins, and nobody will know that they affected that transaction, because there's no way for the governments to be spying on every single small business simultaneously.
Very cool. David, I see the gears turning in your head. I wonder if there's any additional commentary you'd like to add there.
No, I think it's, we're living in a very interesting time where new dynamics can shape how, the system is revolutionized, right? We don't know what that's going to look like. And, what's interesting is, we may have this marriage of old and new. I think the fundamentals are, very sound for, barring an Armageddon for these commodities like we've talked about. And if the eventuality is this new, more efficient, more stable, more reliable system, I think that everyone's going to be better off, in the long run for that. And we need these, open markets to be able to sort of help drive this type of innovation, which is what we should be, supporting.
Very cool.
I think it all points to Peter's earlier point, where he talked about the importance of a free market economy. And I mean, I think that marriage between gold and digital currencies is just going to make everything more efficient, right?
Yeah, it would already be happening to a bigger degree right now if it wasn't for all the anti-money laundering laws that are already on the books that really add to the cost of doing this. So, if we had a free market right now, if you didn't have to comply with very expensive and complicated rules, we would already have, I think digital currencies backed by gold would be flourishing right now. I mean, I think they would be in widespread use. I think the reason they're not is because the government has already erected a pretty substantial barrier. But as the inflation rates accelerate and the benefits of real money continue to gain value, at some point, the value will exceed the cost of complying with the regulations, and then they'll really flourish.
Yeah. Very cool. Now, folks, we're approaching the end of time, but there are 3 unasked questions from the audience that I'd love to ask in speed round. So to either Wes or David, the first one can be for either of you. Why do junior miners never seem to set any target dates for going into production? Haven't they got a target date? This is asked by Tim.
Well, they shouldn't be going into production is the short answer, because junior miners, that's not their expertise. Their job is to go out and find gold deposits, not to develop them.
Yeah, I agree with that. That's where you get your most leverage as well. You guys did a piece on the Lassonde curve a little while ago, and investors in that space, you're investing in the equities are leveraged to the commodity mostly, and as you get more and more junior, you have more and more leverage. So if you're looking for your best bang for your buck, you want to be into that phase right at early on or pre-discovery, and hope for that exit through the M&A activity with a major.
Exactly.
On 6.com, if you type in Lassonde curve in the search bar at the top, I think we have a full video series, I think with David actually as one of the speakers there. And so there's a lot of really wonderful content there, just for anyone that's listening. The other question, and this one is for Peter, apart from liquidity, are there any benefits to buying gold through an ETF or fund rather than physically? And what is a good markup when buying gold?
Well, there are some benefits. It's certainly a lot easier, especially if you're dealing with a retirement account where you have to have a third-party custodian anyway. I mean, we help people through Schiff Gold set up self-custodied IRAs where they can own physical gold, but there's a cost there. It's more expensive than just buying the ETF. But ultimately, I think gold-backed digital currencies could make ETFs obsolete, because I think they'll actually be able to have an even superior cost equation for holding your gold. And of course, you'll have the added advantage of the greater utility of being able to use it. So, if I have a share of an ETF, the only way I can access that is to sell it and get dollars and then spend those dollars. But if I owned a gold-backed crypto, I could just spend my gold, just like I would have instantaneous access to utilize that savings in any kind of commercial transaction I wanted with anyone anywhere in the world. So you have that added utility that you would not get if you had your money tied up in an ETF in a brokerage account, where it would take you several days to maybe access it in a way that you could then send somebody a bank wire or a check, which would be even more expensive than directly transferring some of your gold tokens. I mean, if I can't send you, if I have shares of an ETF, I can't, send you some of my shares. I mean, I can sell them and then send you the money. But if you have gold-backed tokens, I can just send you the tokens. I don't have to sell them. Just send them whatever, however many you need, or a fraction thereof. You can break them up into a tiny fraction. So you can send $10 worth of gold anywhere in the world, anytime you wanted to. So I think that will compete. But for a lot of people, yeah, I mean, right now, given the option of storing gold or silver, some people are worried about having to pay insurance. Some people are afraid they may lose it. Somebody may steal it. So these things, as long as the costs are not that high, you're basically paying storage costs. That's really what the ETF is. You can buy them for next to nothing. The brokerage commission is very low. You can get free trades at a lot of these discount brokers. So the real cost is the embedded storage cost. That's inside these ETFs, right? You're paying somebody maybe 25 basis points, 20 basis points to store your gold. Now, if you want to do it yourself, well, then you don't have to pay the storage fees. But, you have other costs. You have shipping, right? Insurance, other things costs that you might incur in storing your own metal. But yeah, do you take an added risk? Yeah. What if the ETF doesn't really have the gold? What if it's what if, then yeah, this price could drop a lot if it turns out that there was a fraud. But, there's auditing and there are independent audits and ways, people look at these things and they verify that it's legit. So if you buy, a well-known ETF, that risk is probably small. I mean, again, you can store the gold yourself and somebody can steal it. So there's always that risk.
Very cool. And last question, this time over to Wes and David. This is a question asked by Michael. Over the last few years, most economic studies have used discount rates between 5 and 8%. What should the discount rate be now to compensate for current higher interest and inflation rates?
My own view is that, I mean, if you're evaluating a gold project for a junior explorer, I mean, the concept of discounted rates is overly punitive, for lack of a better way of putting it. I mean, if you're trying to define a mineral resource that's sufficiently large enough to attract a major to come in and take you over, then like your job is to spend money drilling holes and expanding the resource footprint and let the economics and the evaluation of the mineral reserve, leave that in the hands of the professionals that have a better understanding of the future and the mine development costs associated with that to set their parameters. So, from a junior explorer, it's not relevant. I've worked on the other side. I've been with majors who've developed mines and been part of teams that have studied them. I mean, it's typically 5% on the gold space, but I think that's overly punitive as well. It's the gold price is just too dynamic.
Yeah, the amount of variables that are components of these economic evaluations are significant, right? And there's a lot more volatility in them. I think that's to Wes's point than interest rates. Should it be higher? Yeah. Are we in a riskier environment? Yeah. What's realistic? You can look what's out there. I think they do have merit. It's difficult a lot of times for investors to sort of try to sort of say, okay, well, there's this size of a deposit, but what does that look like coming out of the ground, right? And to be able to sort of have some sort of parameter to be able to evaluate that, I think it can there's value in doing it that way. Listen, all the majors will have their own expertise to do it on their own, but in terms of a company to show, like, listen, every 1,000,000-ounce gold deposit is not the same, right?
Exactly.
What's the grade? Where's location? What's the infrastructure? So I think you do want to be able to communicate that. Like, I know with the white gold being so high grade and near surface discovery that there's we haven't published anything yet, but internally we've done our own work, and we were quite pleased with what we see. But that doesn't mean something somewhere else that maybe has different infrastructure or different energy needs would stack up the same. So there's certainly a role for it. Notwithstanding, to go from a PEA to a feasibility, which is what you really need to get the banks. There's a lot of work, and there's a lot. People should take this all with a grain of salt, right? I think PA is like probably plus 30% variabilities, and then there's a lot of these little embedded things that maybe people don't pay attention to. What foreign exchange rate did you use? What energy cost did you use? Pit slopes, this, that, and the other thing. So just to sort of point out one variable, although it's a big one, there's another half a dozen of they're as important in there that have as significant of an impact. So you really got to kind of look at the whole package together.
Yeah.
Very cool. So folks, with that, we are at the end of time. David, Wes, Peter, and Rick, thank you everyone for participating in this panel. It was a lively discussion with a tremendous amount of audience questions. I'll throw it over to each of you for any closing remark or thought. David, over to you.
Yeah, this was great. I learned a lot, Peter. Great to sort of be on a panel with you. Everyone kind of sings your praises, and certainly see why. This is an interesting time, right? Someone a lot smarter than me has said, when there's blood in the streets, this is the time to be investing. And not financial advice, but I think in the junior precious metal market, that we're certainly seeing that. We have this all-time discrepancy between the value of the underlying commodity and the value of the equities. A lot of great arguments were presented today why we think these commodity prices are going to go a lot higher. So it could be a really unique opportunity to participate in a very significant re-rating and equity value increase environment. So exciting time. I know with white gold, like, I've never been more enthused about the prospectivity of the company. We have, a very significant large grade, high grade resource. It's in an excellent place. We have, literally half a dozen major mining companies that have invested in the area. These guys have done their homework, and this incredibly exciting blue sky portfolio. We made major discovery last year, very high grade surface, right next door to Newmont's coffee project, and we couldn't ask to be in a better place. So a lot of exciting things going on, and we really think that there's some tremendous tailwinds that are shaping here for our industry.
Daniel, thanks again for hosting us today. It's been extremely interesting, and I can see why Peter has such a large fan base. He's raised some points that actually made me think a lot. So I'm going to ponder some of those. But it's a great time to be involved in the gold space. I think the opportunities are second to none. I think there's a lot of good companies out there, and I think investors have to place their bets and look at companies that are well run with great assets and opportunities to deliver their goods and professionals, like run by professionals. And I think that's the biggest advice I can give someone.
Take care.